Index funds have exploded in popularity since the first theoretical model for an index fund was suggested in 1960. According to the Financial Times, index funds have now broken through over $15 trillion as the ETF index fund boom really heats up, and over half of US stock fund assets are now invested into index funds. For the first time, passive index funds look like they'll be overtaking active investing, which shows the power of the retail investor market, but also how dangerously passive the market is becoming. Historically and in general, we tend to invest in market-weighted index funds. What if I told you these are outdated and there's a new kid on the block, but you still don't have to put your head in the sand trying to analyze companies and their statements to make individual decisions on individual companies? The past decade observed a shift from active to passive investing, with a massive flow of assets under management moving from actively managed funds to ETFs and index funds. Looking at some of the popular players in the market, Vanguard holds over half the market share for passive funds, followed by BlackRock, State Street and Fidelity. The S&P Dow Jones, the MSCI and the FTSE Russell hold more than half the market share in the ETF index fund competitive landscape. As you can see here from Bloomberg, this chart shows that BlackRock was the issuer with the largest inflow in passive ETFs, followed by Vanguard, which held the largest inflow for index mutual funds. Fidelity displays an interesting pattern with the largest outflow in active mutual funds, which corresponds with large inflows into index mutual funds. But market-weighted index funds have been around for a while, with new funds, called equal weight index funds, making a bigger appearance. Does this mean we're seeing the death of weighted index funds? Well, let's look at one of the most popular Vanguard funds, the VUSA, or VUSA as some people call it. This is an index fund that tracks the S&P 500 and has a weighting on the technology sector of 27.9%, followed by healthcare at 14.3%. And then slowly, as you go down the list, your money gets distributed. This means if you invested $100 into VUSA on Vanguard, then $27.9 would go straight into the tech stocks, and introducing $7 of that going straight into Apple, $6 into Microsoft, and $3.30 into Amazon. With equally weighted portfolios and index funds, let's take the Invesco S&P 500 Equal Weight ETF, which has a ticker symbol of RSP. In this fund, only 15% is invested into tech. Now, this is still a large amount, but at a high level, your funds are more equally distributed across the fund, which is good for two reasons. Firstly, it helps diversify your money into potential growth stocks that you'd have lesser exposure to in a market-weighted fund where it's more tech-heavy. And secondly, it would also lower your exposure to market volatility, like we've seen this year in tech stocks, which have had a huge crash, although at the moment they don't seem to be doing too bad in 2022. But who knows where we'll end up at the end of the year. The problem with market-weighted index funds, they put a large percentage of funds into the biggest companies because, well, they're the biggest companies. As big tech companies, the index funds dump more and more money into their pots, and they get bigger, their valuation increases, and thus they become more attractive, and this becomes what feels like an evergreen cycle of amazing returns every single year. Which leads me on to the next section, the problem with this. The challenge is a lot of money is pumped into tech stocks at the moment and has been for the past few years, meaning we have a huge reliance on Apple, Microsoft and Google doing well and keeping the stocks floating upwards, which actually, when you think about it, is a lot of responsibility for them to keep performing. That's why with a lot of people investing in the S&P 500 or the Nasdaq or finding specific technology-based funds, the stocks went down a lot this year, since the whole tech sector and venture capital focus is shifting away from growth and more into profitability, and with a lot of people like me and you investing in these easy market-weighted index funds, we suffered huge losses, and it's been a wild ride so far this year. The problem is, if we put all of our weighting into the tech sector and they don't do particularly well, then yes, by pumping more money into them and increasing the value further is totally one big bubble. But the big question is whether the tech companies are the engines for growth going into the future. And that's the key to understanding and believing that they will still grow into the future, even if this year is more of a tough year. But the classic thing to do when markets get hot or exciting is to call it a big bubble. But even the Big Short's own famous investor, Michael Burry, has said that he thinks tech stocks, along with other types of investments, are still in a bubble despite short market rallies in a wider bear market. So this does make me question whether entertaining equal weighted stocks might be a little bit better to at least help mitigate some of that potential drop. So let's compare. When you compare the past 10 years looking at the Vanguard S&P 500 index fund and the Invesco equal weighted fund, you can see from 2011 up to about 2017, they were sort of neck and neck. And it's only more recently, due to the tech explosion, that the market weighted fund started to outperform and widen that gap, thus giving you greater returns. That initial $10,000 with the dividends reinvested would have given you $37,200 in the equal weighted fund and about $41,000 in the market weighted fund. So here, there's a clear winner. But this graph shows that if the market weighted fund can create that kind of gap when the stock market is strong, then in theory, if the tech market went sour in the future, that gap could be the opposite, and instead, we might see the equal weighted fund outperforming and being on top. If you look at this second graph, in the blue, you can see that in the earlier years from 2012 and 2013, the equal weighted fund outperformed the market weighted fund before dipping in 2015 and again outperforming it in 2016 and again in 2021. So this shows it's not an impossible theory. But then, if you look at 2022, look what's happened. Just as I explained, the market weighted fund has dropped more than the equal weighted fund for the first time, making equal weighted funds far more attractive when investing in the same stocks. If Michael Burry's prediction is right and the tech bubble still needs to burst, then I'd much rather have my money in the equal weighted fund than in the market weighted fund, because I know I'll at least limit some of my losses. But what's also important to call out here, looking back over the past 10 years, the equal weighted portfolio has actually had the best year at 35.54% growth versus the market weighted fund at 32.39%. And the worst year is only down 9.54% for the equal weighted fund and was down a larger 12.59% for the market weighted fund, which means the equal weighted fund has had, in the past 10 years, although not the highest long-term gain, it has had the best highest performing year and the best worst performing year out of the two funds. So Matt, that sounds great. Does that mean we should all invest in equal weighted funds? Well, it all depends on your appetite for fees and performance. Fees are always one thing to consider. On Fidelity, I invest in the Global Technology Fund W Accumulation, which is quite expensive and it's market weighted. It has a 1% charge a year and a 0.54 transaction cost annually, and I'm paying about £20 a month in fees across my ISA and pension. But when I compare that against the Vanguard VUSA fund, it has far outperformed Vanguard, so I'm happy to pay the higher fees. Across 2017, 18, 19 and 20, Vanguard's VUSA gained 71% versus the Fidelity Global Technology Fund, which gained 110% in the same time. But of course, if the tech bubble bursts, then I'm more exposed. But even paying 1.5% over the 0.07%, if you compare this to the equal weighted fund at Invesco, you'd be up 60% over that same time period and pay 0.2% fees. So actually, when you look at it this way, if you invested in the Vanguard fund, you'd have an extra $4,000 and pay less in fees for a market weighted versus the equal weighted fund. As always, it's never a straightforward answer, and you have to look at it from many angles to decide what's right for you, but hopefully this has given you some interesting food for thought on different types of index funds that are effectively the same companies that you can totally tailor it to your appetite for risk and willingness to pay fees. So what will you do? Let me know in the comments what you would do. Does this change your mind about the type of index fund you're investing in? For me, most of my cash is invested via Fidelity rather than Vanguard or Invest Engine, that I do dabble with them a little bit in their available funds. If you enjoyed this video, then check out this video here, which are the top mistakes for beginner Vanguard investors make when they're starting out. Check out this video here, see what the mistakes are and see what you can learn, and I'll see you in the next video.